Listen up, because it's time to talk about whether a hike in capital gains and dividend taxes would hurt you, or if all the talk to that effect is just rhetoric. Michael Lind is the policy director of the Economic Growth Program at the New America Foundation. He says cutting capital gains taxes right now is irresponsible. Opposing him, Ryan Ellis, director of tax policy at Americans for Tax Reform. Okay, good to have both of you with us. Ryan, let me start with you. Ed Rendell, Democratic governor of Pennsylvania, said, let's put it on the table to cut capital gains to zero to stimulate the economy. Others say, no, that would be crazy. President Obama's plan, by the way, is to increase the rate from 15 to 20%, not to the 39.6 it had been before the Bush tax cut. So, can you make the case for a cut today?
Well, first of all, President Obama's plan is to take it from 15 to 20% next year, and everyone forgets about Obamacare. Obamacare is going to take it to 24% in 2013. That's the wrong direction that capital gains taxes need to be going in. People need to understand that capital gains taxes are what the government takes out of people's profits. We want to leave after-tax profits in the hands of investors so that they can reinvest that money and grow the pie even more. We don't want to be raising the capital gains tax rate right now or ever, but it's certainly not right now.
Michael, make the case. Can you fight for the other side? Can you fight for why
Sure.
why we should go from 15 to 20 or even to, as Ryan pointed out, 24?
Well, I don't want to get into the numbers, but let's look at the situation. To begin with, most business investment in the United States is financed out of returned earnings of corporations, not out of the capital gains tax rate. It's not going to be affected by that. The reason businesses are not investing is a lack of demand, not a lack of incentives from the tax side. Now, when you have this crisis of aggregate demand, there are three possible sources of demand. One is foreign export markets, which can do some good. The other is private consumers. And at this point, consumers are paying down their debt, and we want them to continue doing that. So as long as they're deleveraging the private household sector, the third alternative, which is public spending and productivity-enhancing investments like infrastructure, makes much more sense than any supply-side tax incentives.
Ryan, why would cutting capital gains help more than just the wealthy? Because that seems to be the crucial point that needs to be made to win this battle in the public sphere. I mean, we all know half of Americans own stocks through mutual funds or 401ks, but most of those people aren't buying and selling. They're buy and hold. So that argument doesn't hold with most of those people. How can you fight through that?
Well, here's the thing. When you cut or raise the capital gains tax rate, what you're doing is you are cutting or raising the after-tax rate of return on investment. If you are going to invest money and make a $1,000 profit, and the government's going to keep 30%, and you get to keep the other $700, that's one level of incentive to go and invest. Now, suppose I were to cut that, and instead of a 30% capital gains rate, let's say we only had a 10% capital gains rate. And instead of keeping $700 after taxes, you keep $900 after taxes. What that's going to do is it incentivizes people to get out there, allocate investment, pump up the economy with the needed investment capital that is so sorely needed right now. That helps people even if they have tax-deferred accounts like IRAs and 401ks, because all of the resultant investment activity from getting the incentives right drives up the overall price of the stock market.
Now, that's where I'm interested, Michael, on your point of view, because it would seem that if you're going to dramatically change the rate, increase it, that people would sell, right, to capture the lower rate, but then they would buy again the minute the next year taxes started. So it would really be a very temporary impact on the market.
Well, and in addition to being temporary, you have the problem of leakage in a global economy. You know, now if you have a rational, well-to-do investor, he or she is going to distribute his investments around the world, and particularly be investing in emerging markets, which may have more of a prospect for growth in the United States. So as a way of encouraging investment in the United States, unless you have different capital gains tax rates for a domestic investment, foreign investment, you know, you run the risk of simply stimulating foreign economies.
How do we compare, Ryan, when you look overseas in terms of our capital gains dividend tax rates versus a lot of these markets that are so popular right now, Brazil, Russia, India, China? How do we compare, and how is an American taxed if you own a share of, say, in a Chinese company, you sell it, bring that money home? Do you pay the normal rate?
Well, there's 2 points there. First, a lot of the emerging economies, especially those out of the former Soviet bloc, don't even have a capital gains tax rate. And the reason that they don't is because they realize they want to incentivize investment in their country. They want to incentivize people to allocate capital and take risks and then share in the profits if they make a rate of return on that. The second point is that the United States is one of the few remaining developed nations that seeks to tax what's called worldwide income. That means that if you are a U.S. taxpayer and you earn money overseas, then you are not only going to be liable to pay taxes on that income overseas potentially, you're also going to be liable to pay taxes on that income right here at home. That can often lead to a double taxation of investment allocated savings, and that's another disincentive we need to take care of in the code.
All right, Michael, Ryan, thank you very much. An interesting conversation. And viewers, let us know what you think. Is obviously going to be a very important territory as we talk about tax policy. Street Signs at CNBC.com, your view on capital gains and dividends taxes.